Welcome to this deep dive. We're tackling a topic that's, well, constantly in the headlines: executive compensation.
It really is.
How do the people running our biggest companies actually get paid? What forces shape those often enormous paychecks? And, increasingly, what kind of voice do shareholders have in the process?
It's a really dynamic space, driven by complex goals, different theories on what works, and definitely growing public and investor scrutiny.
Yeah.
We're looking at significant sums of money here and trying to understand how they connect or maybe don't connect to performance, responsibility, and, generating real value.
Exactly. So our mission for this deep dive is to unpack two major forces shaping executive pay right now.
Okay.
One is the growing trend of linking pay to environmental, social, and governance performance. We'll call that ESG pay.
Right, ESG pay.
And the other is giving shareholders a formal vote on pay packages, known as say on pay.
Got it. So ESG pay and say on pay, we're going to try and cut through some of the technical language, maybe pull out some surprising facts from recent analysis,
Yeah, definitely.
and explore what these trends mean for companies, executives, and, well, ultimately for anyone invested in or impacted by these businesses.
All right, let's dive in then. First, let's get our bearings. What exactly do we mean by ESG pay?
Okay, so at its core, ESG pay means that a portion of an executive's compensation, think bonuses, long-term incentives, is tied to hitting specific goals
Goals related to.
related to the company's environmental footprint, its social impact, or its governance practices. So instead of just hitting financial numbers like revenue or profit,
Uh-huh.
an executive's pay might also depend on, say, reducing carbon emissions or improving workplace diversity or hitting specific ethical sourcing targets. Their payout goes up or down based on how the company performs on these, well, non-financial metrics.
Okay, so it's about broadening what counts as performance, beyond just the quarterly financials. And say on pay.
Say on pay, or SOP, that's the mechanism giving shareholders a voice on these compensation packages.
A voice, huh?
Well, regulations in various countries require companies to let their shareholders vote on executive pay. Now, sometimes these votes are advisory, basically, a formal recommendation.
Like a suggestion.
Yeah, exactly. And sometimes they're binding, meaning the company must act on the outcome. But the basic idea is to give the actual owners of the company a say in how the top leadership is compensated.
Got it. ESG pay, tying comp to non-financial goals. Say on pay, giving shareholders a vote. Okay, let's dig into ESG pay first. We're seeing this pop up more and more, right?
Absolutely. It's a significant global trend. And companies are adopting it for a few key reasons. A big one is simply investor preference.
Really? Investors pushing for it?
Yeah. Some shareholders and board members genuinely prioritize strong ESG performance. They see it as intrinsically valuable, sometimes even accepting a potential trade-off on immediate financial returns for better ESG outcomes.
Huh. So it's not always just about the short-term money, even for investors?
Not purely short-term money, no. There's also a strong argument, kind of the doing well by doing good idea, that strong ESG performance can eventually impact financial outcomes too.
How so?
Well, building better relationships with employees, customers, the community, strong stakeholder engagement that can pay off down the line. Plus, metrics like reducing carbon emissions are increasingly seen as signals of future financial risks,
Ah, okay, like climate-related costs or...
or assets becoming obsolete, like things tied to fossil fuels, the whole stranded assets idea.
Right, right.
And just from a pure incentive design perspective, like other non-financial metrics, think customer satisfaction, ESG goals, can be leading indicators of future performance. So including them in pay contracts might make those incentives more complete than just using share price alone, which is really backward-looking.
Okay, that makes sense. Can you give us a real-world example, a company putting this into practice?
Schneider Electric is a good one. They tie a substantial part of executive pay to sustainability.
How substantial?
We're talking 20% of annual compensation and 25% of long-term incentives linked to their sustainability impact and ESG scores.
Wow, that's a big chunk. Seriously.
It is. They had this program Impact 2018-2020 with really clear targets across areas like climate, circular economy, health and equity, ethics, development.
So really specific things.
Very specific. Things like increasing renewable electricity use, improving CO2 efficiency in transport, using recycled packaging, boosting employee engagement, safety metrics, closing gender pay gaps, anti-corruption training, even expanding access to energy in underserved communities. And they tied these into frameworks like the UN's Sustainable Development Goals.
That level of detail is fascinating, but, concerns always pop up. Is this always authentic, or is it sometimes just for show?
That's the million-dollar question, isn't it? There's definitely the risk of window dressing or greenwashing.
Right.
Companies adopting ESG pay mainly for the PR value without a genuine commitment. And it's also just plain hard to measure many ESG variables objectively.
Yeah, I can see that.
Plus, the lack of transparency in how these metrics get weighted, how targets are set, how the final payouts are calculated, that's a valid concern too.
So who is adopting ESG pay? Does the analysis give us any clues about the why?
It does. You can sort of think of firms falling into three broad categories based on their approach. Some have no ESG pay, maybe prioritizing traditional financial returns.
Okay.
Others might use it opportunistically, perhaps driven by image concerns, like you said. And then you have firms with a more committed use, where owners either genuinely care about ESG or see these metrics as truly valuable indicators of future performance and risk.
And are there common traits among those who adopt it, like patterns?
Yes, analysis points to several characteristics. Firms in industries with a bigger environmental footprint, think heavy manufacturing, are more likely to adopt it.
Makes sense.
Location matters too. Adoption is higher in countries that strongly value environmental protection or have mandatory ESG disclosure rules. Larger firms, facing more public scrutiny, are more likely to use it. Also, firms with more volatile performance might find ESG metrics offer useful, maybe more stable information.
What about companies that have already made public commitments, like net zero targets?
Exactly. Firms with existing public ESG pledges are much more likely to link pay to them. It adds credibility, right? Makes those pledges seem more serious. And shareholder pressure is definitely a factor. Institutional investors, sometimes channeling their clients' views on ESG or climate risk, can actively push companies towards ESG pay.
And the board itself. Does the makeup of the board matter?
Seems so.
Yeah.
Analysis shows a positive link with a higher percentage of independent directors and also female directors on the board.
Interesting.
And interestingly, firms where insiders own over 50%, like a controlling shareholder, they're less likely to adopt ESG pay.
So it's a mix. Industry, location, size, existing promises, shareholder push, board makeup. How do those big investors specifically influence this? The Vanguards, the BlackRocks?
Yeah, the big three, they're very influential. Foreign institutional investors and engagement from these major asset managers strongly encourage firms to include ESG metrics in pay.
And they put their money where their mouth is.
Seems like it. These major investors tend to increase their holdings in companies that actually adopt ESG pay.
Okay, so they're pushing for it, companies are adopting it. Does it actually work? Does using ESG pay lead to better ESG performance? Or is it just talk?
The evidence suggests it's not just symbolic. Research shows executives and firms with ESG pay are indeed rewarded financially for reducing carbon emissions. That's not the case in firms without it.
Okay.
And when carbon emissions are tied to executive KPIs, guess what? They actually decrease. Overall, ESG ratings also tend to improve, particularly in places like Europe or countries with mandatory disclosure.
Right, but what about the financial side? Does better ESG performance driven by these pay links translate into better financial results? Higher profits, better stock returns?
That picture is, well, less clear-cut. Looking at an overall ESG pay indicator, analysis hasn't shown a consistently significant positive effect on accounting profits or stock returns.
No boost.
Not consistently. In fact, some studies focusing specifically on carbon-linked pay have sometimes shown a negative association with financial performance.
Negative. So it costs money.
It might mean there are trade-offs, perhaps short-term costs for long-term gains. Or maybe the financial benefits are just longer-term and harder to capture in standard short-term analysis. Still being debated.
Okay, so the key takeaways on ESG pay seem to be it's growing, specific factors predict who adopts it, it does seem to drive improvements in some areas like emissions, but its direct link to short-term financial gains isn't proven yet. Might even involve trade-offs.
That's a good summary. And, new analysis keeps adding layers. Like one recent study found U.S. firms exposed to the EU's new CSRD regulation via their European subsidiaries were more likely to adopt ESG pay.
Regulatory spillover.
Exactly. And this adoption was linked to higher social scores later on, but potentially lower Tobin's Q, a measure of firm value in that particular study. So it's still nuanced.
Definitely a complex area. Okay, let's pivot now to the other big trend, say on pay. What were the main concerns that led regulators to step in and give shareholders this vote in the first place?
Well, the primary driver was concern over the sheer level of executive pay, especially when you compare it to the compensation of average workers.
And that gap, that disparity, has grown massively, hasn't it?
Dramatically is putting it mildly, particularly in the U.S. If you look at the top 350 publicly owned U.S. firms, the ratio of CEO pay to the average worker's pay. Back in 1965, it was around 20 to 1. That's using the value of pay when it was granted.
20 times.
By 1990, it was 60 to 1.
60 times the typical worker. That's already a huge jump.
And then it just exploded around the year 2000. Peaked near 400 to 1 on a granted pay basis.
400 times.
Yeah. It's come down since that peak, thankfully. But in 2023, it was still around 190 to 1 on a granted basis and nearly 300 to 1 on a realized basis.
What's the difference? Realized versus granted.
Granted is the value estimated when the pay package like options or shares is awarded. Realized includes the actual value when options are exercised or shares vest, which can be much higher if the stock price went up. And the typical worker here is usually based on average pay for production and non-supervisory workers.
Wow. 300 times the average worker, realized. How does that compare to other high earners, not just average workers? Are CEOs pulling away from everyone?
Even compared to other top 0.1% earners, yes, CEO pay has surged. Between 65 and 78, the average CEO pay was about 2.6 times that of other top 0.1% folks. By 2022, that ratio was 9.4.
So nearly 10 times what other very top earners make. They're not just outpacing that average worker, they're outpacing other elites too.
Exactly.
And internationally. How does the U.S. stack up in these ratios? Is it like this everywhere?
No, the U.S. really stands out. Data from 2018 showed the U.S. CEO to average worker pay ratio at 265. The U.K. was 201, Germany 136, Canada 149. Many other developed countries were way lower, often below 100.
So much, much larger pay gaps in the U.S. compared to places like the U.K. or Germany.
Significantly larger. And that sparks debate, right? Is it regulation, different social norms, maybe just the scale and complexity of U.S. businesses? There's also talk, especially in the U.K., about whether their stricter rules might actually discourage companies from listing there compared to the U.S.
Finding that balance.
Always trying to balance shareholder protection with attracting top talent. It's tricky.
Okay, so the level of pay was one huge concern. What was the other main driver behind, say, on pay?
The other big concern was performance sensitivity. Was executive pay structured so it really rewarded executives only when they performed well and maybe penalized them when they didn't.
Ah, the pay for performance link. Or lack thereof sometimes.
Precisely. And this is where we get those two main competing explanations for why compensation trends look the way they do.
Right, the competing theories.
Exactly. One is the managerial power hypothesis. This view basically argues that executives have significant influence over their own pay-setting process.
So they can kind of rig the game?
Well, they can potentially extract more than is optimal for shareholders getting rents, as the economists call it.
Rents, meaning pay above what's truly justified by performance or market.
That's the idea. They can push pay higher, limited mainly by the outrage constraint, basically, the risk of public or shareholder backlash if the pay seems too excessive.
So they try to avoid that outrage.
Right. And they might use camouflage, designing pay packages in ways that make potential excesses less obvious.
Camouflage, like hiding the big numbers. How does that work?
Could be things like using options where the strike price is already close to the current stock price, making them seem less valuable initially. Or a classic tactic, picking a group of much, much larger companies to use as a peer group for comparison when setting their own pay.
Ah, I've heard about this, like that Tootsie Roll Industries example.
Perfect illustration. Back around 2008, Tootsie Roll's revenue was about $500 million. But for comp benchmarking, their peer group included giants like Kraft Foods with $42 billion in revenue, General Mills at $13.7 billion, Kellogg at $12.8 billion.
Ooh, companies dozens of times bigger.
Exactly. Comparing your CEO's pay to those running vastly larger companies can really inflate the benchmark for what seems like market pay.
That makes it hard for the board to argue against, even if it seems high for their company size. This managerial power view sounds pretty skeptical of the board's role then.
It definitely highlights potential weaknesses. Management often has influence on who gets on the board. Boards are collegial places. Directors might be hesitant to challenge the CEO. Many directors are CEOs themselves elsewhere.
Right.
Their personal incentives to really fight over pay might be weak, and they always have less information than the CEO. Plus, the fact that compensation consultants are usually hired by the company, not the board committee directly, raises potential conflict questions too.
Okay, so that's one side. Executives have power, influence pay, maybe hide it a bit. What's the competing view? The other explanation.
That's the optimal contracting hypothesis.
Yeah.
This view argues that, no, executive pay is high and structured the way it is because it's designed to maximize shareholder value.
So high pay is actually good for shareholders.
That's the argument. High pay reflects things like the massive growth in firm size and complexity. The CEO job itself has changed, maybe more demanding, less secure, needs broader skills, and importantly, increased pay performance sensitivity. The idea is you need to offer huge potential incentives, and thus potentially huge payouts, to get the absolute best performance that benefits shareholders.
So two very different takes on why pay is so high.
Right.
How have regulations like Say on Pay tried to step into this debate? Let's look at the U.S. first.
Okay, the U.S. approach evolved. There were tax changes, like the 93 rule limiting the tax deduction for executive pay over $1 million. Though performance pay was exempt initially, that exemption got removed in 2017.
Right.
But the big change for Say on Pay came with the Dodd-Frank Act in 2010.
Dodd-Frank. Mostly known for financial regulation after the crisis, but it hit pay too.
It did. Mandated better disclosure of exec pay. Required listed companies to have independent compensation committees, set rules for consultants reporting to those committees, and crucially, it required companies to hold advisory, non-binding shareholder votes on the pay of their top 5 execs at least every 3 years.
Advisory, so not binding.
Not binding, correct. Plus, stock exchange listing rules generally require shareholder approval for most equity-based pay plans anyway.
What about challenging pay in court? We saw that huge Tesla case recently. Is that common?
Challenging exec pay in U.S. courts via a shareholder derivative claim, suing on behalf of the company, is actually very difficult. Courts usually apply the business judgment rule, basically assuming directors acted in good faith unless there's strong evidence otherwise.
But the Tesla case, avoiding Elon Musk's massive package, that did succeed. Why was that different?
That was pretty unusual. The court found it was essentially a conflicted transaction. They determined Musk was effectively a controlling shareholder with huge influence, was heavily involved in getting the package approved, and crucially, that key information wasn't fully disclosed to shareholders before they voted, particularly about the lack of independence of some directors involved.
So the process was flawed and information was missing.
Exactly. It was a rare case where those high legal hurdles to challenge pay were actually overcome. That's why it made such big waves.
Makes sense. Okay, how does the UK regulatory setup compare? You mentioned they've had disclosure for a while.
Yeah, UK has had disclosure rules for ages, but their say-on-pay structure, especially since 2013, is quite specific. Companies have to put 2 things up for a vote.
2 reports.
Kind of. A backward-looking report detailing how much execs were actually paid, comparisons to peers, how exec pay changes compare to average employee pay changes, and then a forward-looking policy.
Was in the forward-looking one.
That outlines the pay components for the coming years, the performance targets, how pay links to performance, basically the plan going forward.
And the vote itself, is it binding?
Here's the key difference. Shareholders get a binding vote on that forward-looking policy at least every 3 years. If it gets voted down, the old policy stays, which creates real pressure to revise it.
A binding vote on the future plan? Okay.
And they also have an annual advisory vote on the implementation report, basically asking shareholders, do you approve of how we applied the policy this past year and how much people got paid?
Got it. Binding on policy, advisory on implementation, and independent comp committees.
Standard practice, yeah, though technically on a comply or explain basis.
Can shareholders sue in the UK, like in the US?
A derivative suit is possible if payments clearly violated the approved policy, but outside of that clear non-compliance, you generally need to prove bad faith or fraud to win a pay challenge in a UK court. So still a high bar, just structured a bit differently.
Okay, so the rules are in place, votes are happening. What does the research say about the actual impact? Did Say on Pay really change things?
Well, early evidence from the UK, looking back at when they introduced their advisory vote in 2002, gives us some clues. One study looked at the market reaction when the rule was announced.
What happened? Did stocks move?
They saw positive, abnormal stock returns for companies that seemed to have excessive pay, or those generous reward for failure severance clauses, especially if the company was underperforming.
So investors liked the idea of more scrutiny.
Seems so. It suggests investors saw the new rule as potentially valuable, particularly for rating and pay that seemed disconnected from performance. They also looked at how companies responded if they got a high dissent vote, say, over 20% voting against the pay package.
What did those firms do? Did they just ignore it because it was advisory?
No, they often took action. Especially on controversial stuff like severance pay, They reduced notice periods. They also tightened up performance conditions for equity grants, like getting rid of retesting if targets weren't met initially, or just making the targets harder. About a third of firms with high dissent reported making changes agreed upon with shareholders.
So even advisory votes had teeth. Companies felt the pressure. Did it change the pay performance link itself?
This is a really key finding. Analysis showed that CEO pay became significantly more sensitive to stock underperformance after the advisory SOP rule came in.
More sensitive to underperformance, meaning pay went down more if the stock did poorly.
Exactly. One measure of that link almost tripled in statistical significance after SOP.
Mhm.
So even an advisory vote seemed to make pay more punitive when things went badly.
That's fascinating. Okay, what about later evidence, especially with the UK's binding vote since 2013 and experience in the US?
Well, approval rates for say-on-pay votes generally remain very high, usually over 90% in both the UK and US. Outright failures less than 50%, yes, are pretty rare, like 1–2% typically. In the US, Russell 3000, votes over 90% are the norm.
So most pay packages still sail through. Does that mean SOP isn't having much effect now?
Not necessarily. A lot of the impact might be happening behind the scenes. Companies now often engage with major shareholders before finalizing pay proposals to avoid high dissent. So the packages put to a vote might already be tempered.
Ah, preemptive changes.
Could be. The UK advisory vote initially didn't seem to clearly reduce overall pay levels. Pay kept rising, but it did make pay more performance-driven, as we saw.
Did the binding vote in the UK change the level?
There's some evidence suggesting it did have a stronger effect. After the binding vote came in, negative votes became more strongly correlated with high pay policies, not just poor performance. And some analysis suggests executive pay growth has slowed materially in the UK since then. Plus, remember, if the UK advisory vote fails, it triggers a binding policy vote next year, adding extra bite.
Why might binding votes still have a limited impact sometimes?
Well, even strong advisory votes can trigger that outrage constraint and push firms to change. Some international analysis does link advisory SOP to lower pay and better pay performance links elsewhere. In the UK, big investors like the Big Three don't just rely on proxy advisors, and maybe their voting hasn't shifted dramatically. And, cultural norms probably play a role. The US just seems generally more accepting of really high pay.
What about the US advisory votes? What impact have they had?
Research in the U.S. shows that even though they're advisory, rising levels of dissent definitely increase the odds a company will change its compensation plan. If dissent is low, maybe 15% chance of change, but if it hits 30–35%, that jumps to over 70%. Get over 45% dissent, and companies almost always make changes.
So companies absolutely react to significant shareholder opposition, even if it's non-binding.
They do. Other analysis looked at market reactions around really close votes, near that 50% threshold. You see more stock price volatility on vote day when the outcome is uncertain, suggesting the market cares about those marginal decisions, and the probability of a shareholder proposal actually being implemented jumps hugely once it passes 50% approval.
So what was the overall verdict from US say-on-pay analysis? Did it lower pay, improve firm value?
On total CEO pay levels, the research didn't find a significant overall effect, and no big effect on CEO turnover. But there was a small decrease in base salary and an increase in stock and option components.
Shifting the mix of pay.
Exactly. Suggests a shift towards more variable at-risk pay. And importantly, firm value and performance seem to be enhanced by the introduction of advisory SOP in the U.S.
Okay, so it sounds like say-on-pay, whether advisory or binding, hasn't necessarily slashed total pay across the board, but it has increased accountability, shifted pay structures towards performance, and might even boost firm value.
That seems to be the broad consensus, yes. And one final interesting link back to our earlier topic. ESG considerations are now starting to explicitly pop up in say-on-pay votes themselves.
Really? How does that work? ESG in the pay vote?
Yeah, especially in the UK. Analysis shows investors are more frequently citing ESG-related reasons when they explain why they're voting for or against executive pay packages.
What kinds of reasons?
Well, this seems more common among investor groups who tend to follow proxy advisor recommendations. They might cite poor non-financial performance or maybe a lack of clarity in how ESG metrics are actually being measured and tied to pay. It's becoming another lens for scrutiny.
So if the ESG metrics in the pay plan seem weak or unclear, that could lead to a no vote.
Potentially, yes. It adds another dimension. However, it's worth noting that when independent investors vote primarily on the level of pay, their top concerns still tend to be things like how pay compares to the workforce, peer company pay, and poor financial performance. For the groups following proxy advisors, peer pay comparisons are still the biggest driver, followed by firm size and poor performance. Workforce pay is less often cited by that group.
Interesting difference there. Okay, let's try and pull these threads together then.
Yeah.
We've looked at ESG pay, how it's growing, linking incentives to environmental and social goals seems to drive some real change, like lower emissions, but the direct financial payoff is still a bit murky, maybe longer term, or involves trade-offs.
Right. And we explored, say, on-pay regulations giving shareholders that formal voice. It's clearly influenced how pay is structured, pushed for stronger links to performance, even if the effect on overall pay levels is debated and varies.
And both trends really highlight the increasing influence of shareholders, right?
Yeah.
Especially those big institutional investors and the proxy advisors they often listen to. They're demanding more transparency, more accountability.
Absolutely. They also show that regulation, even advisory rules like SOP in the U.S., can trigger real changes in company behavior and measurable market reactions. But while these practices are spreading globally, the local rules, the existing governance structures, the cultural norms, they still really shape how things play out on the ground.
Ultimately, both ESG pay and Say on Pay feel like part of a bigger push, demanding more openness in pay decisions and making boards more accountable to the company's owners.
It's definitely a complex system, and it's constantly evolving. Try and
Yeah.
find that balance.
Yeah.
How do you attract and motivate top talent while making sure executive incentives truly align with the long-term health of the company and maybe its broader impact too?
Yeah, that alignment piece is key. So, given everything we've discussed today, the really stark rise in pay disparities we saw, and the complex, maybe mixed financial results from linking pay to ESG goals, it leaves a big question for you, the listener, to ponder. Does current executive compensation design truly align incentives with the long-term interests of companies, their employees, and society as a whole? And maybe what else might need to shift to make that alignment stronger?
Definitely plenty to think about there.
Thank you for joining us for this deep dive.
Until next time, keep exploring.